Everyone keeps telling you to avoid Melbourne units. I'm going to show you why that might be completely wrong for 2026 and why Melbourne units may be one of the best investments in property you can do over the next few years. Hi, my name is Ben Carrington from Compound Property Buyers Agency, where we help everyday Australians build wealth through property. And although there's been a lot of negativity about Melbourne units, I've looked at the data and what I'm seeing is completely different to what I'm hearing. So, here's what we're going to be covering today. Firstly, I'm going to show you the reasons that are justified why everyone says that Melbourne units are not a good investment. Then we're going to go into the specific numbers on units, the yields, the prices, and what's actually happening in the market right now. And finally, I'll show you the exact type of unit you should be looking for and where to buy them. Let's get into it. Before I tell you why Melbourne units are such a good opportunity, I cannot ignore the fact that they have been a terrible investment over the last 15 years. Now, that sounds pretty crazy, but if you look at the stats, it hasn't been good at all. There's a few reasons for that. Now, the main one is Melbourne went through a boom during the 2010s. And what we saw, or what we always see in a boom, is a lot of development happens. So during that time, there were cranes up all over the city and they built way too many apartments. So with all property, supply is the enemy of growth. And at the time, or for about a decade, Melbourne has had an oversupply of apartments. The other reason they haven't performed is investors have been selling out of Melbourne. And the reason for that is we had the long COVID lockdown, which then forced the government to increase land taxes to try and increase the budget. And then also they've added a lot of strict tenant reforms. Now, the tenant reforms aren't bad. In fact, they're really common sense, but for a lot of investors, there's been enough reasons to sell out. And then there's a value in the other cities. So up until recently, you could have bought a house in Perth or Adelaide or Brisbane for 300, 400, 500,000. So the value just wasn't there when you're looking at a Melbourne unit versus a house in another city. But that has now changed. So investors went there instead. So I get it. I understand why people think Melbourne units are simply no good. But here's what's different now. Construction costs have blown out 40 to 50% over the last 5 years. We also have a lot of red tape in Victoria, which means developers simply can't make it stack. So as a result, there's been very little new developments coming online. And we don't see that changing in the future, which means there is limited supply coming to the market. And think about this. So you've got supply and demand. So supply is now restricted as a result of construction costs and red tape, but the demand since between 2015 and 2025, Melbourne has had an increase of 900,000 people in population. That is adding the Gold Coast to Melbourne's population in that 10 years. And naturally, they all need somewhere to live. So what happens when you reduce supply, you increase demand? Well, exactly what we're seeing. There's less rental stock available, rents are starting to rise, the value is now there because prices have not grown, and as a result, we are seeing investors start to come back into the market. Now, before we go any further, I want to be honest with you. I was like you. I was very anti-units. I used to think you had to buy a 3 or 4 bed house on a 500 square meter block or you simply couldn't make money in property investing. But I've changed my opinion. A few years ago though, it was the right strategy because you could have bought houses for 300, 400, 500,000 in capital cities all across the country. There were so many great regional opportunities to buy in as well, but those days are changing. Now, if you think about it, a unit between 300,000 and 400,000, you can't buy anything else for that. So suddenly the value is starting to be very, very obvious. I've also seen the results over the last few years in Perth, Brisbane, and Adelaide. If you actually look, the unit markets have gone absolutely crazy. Some unit markets have tripled over the last 5 years. So in Brisbane, in some areas, you could have bought a unit, townhouse, villa for 150,000. They're now 450, even up to 600,000. In Perth, we're seeing the same. And if you look at the chart on Adelaide units, they have gone crazy over the last 5 years. In fact, even the other day, Cotality released a report, the top 200 performing markets across the country in 2025, and 7 out of the top 10 were unit markets. So I think the old rhetoric is that units don't grow and that houses perform much better. I think those days are changing. But in saying that, this is very important. You can't just buy any unit. You need to know what you're doing because not all units are the same. So, what type of units should you actually buy? Okay, so the first thing is price point. When it comes to units, we like buying units in the affordable price point. So we're picking them up between 200,000 up to 500,000. Now that may change in time, but at the moment we see really good value in the affordable price points. There's a few reasons for that. The biggest one though is replacement cost. So as we've just explained, the biggest enemy to growth is supply, and units, they do have potential to have more supply than houses because you can simply add more airspace. Now, if you're buying a unit, say a 2-bedroom unit for 400,000 and it costs a developer 500 or 600,000 to build a 2-bedroom unit, not including the land that it sits under, you can see here how you are protecting your downside. And if anything, the more unit supply comes, it actually lifts the prices up of the established units. So we call that buying under replacement cost. Now, when people look at other unit markets, say Bondi, you can buy a 1-bedroom apartment for $1 or $1.5 million. But the reality is at that level, you could buy houses in multiple markets. So I would much prefer to buy 2 houses for $750,000 than a 1-bedroom unit for $1.5 million. The second major benefit and thing that we look for in units is a high yield. So when you're building out a property portfolio, which all of our clients are doing, cash flow becomes really important. You know, if you're buying houses at $700K on 3 or 4% yields, it's great as a foundation, but as far as a portfolio, you're going to eventually run out of cash flow or servicing. 5 years ago, you could have bought houses for that, but these days, it's very hard to get a house with a yield above 5%. So when we're buying units, we're targeting 6 to 8%, which means they have a really strong cash flow, which can be really helpful in a good portfolio. The third thing that we look for is the building type. So you would have heard the horror stories about people buying off the plan or brand new development apartments. Now, I've seen this many, many times. Clients coming to us, they might have bought a 1-bedroom off the plan apartment in Alexandra for $900K, or they might have bought a 2-bedroom unit in Docklands, and 10 years later, there is still no growth. Now, there's a few reasons for that. One is the newer developments, you're paying above replacement value, right? So you're paying the builder's margin, you're paying the developer's margin, so you're paying more than the intrinsic value of the property, and that takes time to catch up. The second reason is that the new developments, quite often there's more of them popping up, right? So it takes quite a long time for all that supply to be soaked up and then the growth to begin. And also, if there's 50 or 100 units in a building, then not only are you competing with other buildings, you're also competing with yourself when it comes to rentals and for sale. So we like to stick to unit blocks between kind of 4 to 16 units, and we like to stick to build dates between kind of, 1960s up to 2000. So it's not a hard and fast rule. There are some exceptions, but overall we like the older units, and we like the blocks that have smaller amount of units as well. A strong reason for this is when you think about it, an older style unit block that has say 4, 10, 12, up to 16 units on it is sitting on a strong land parcel. So they do have good land content, because if you've got 10 units on a 1,000 square meter block in an inner city suburb, you actually have a 10% on you own one of those units, you have 10% of the land. In many cases, sometimes the land value can be so high, it can be almost 100% of the purchase price. So you're getting a good, strong land content, even though it's not your traditional 500 square meter block. Think about the value of a piece of land in Manhattan compared to the value of 500 square meters out in the middle of nowhere. You would take 1 square meter in Manhattan. Now, the next one, and this is the biggest misconception, is the S word, and that is strata. So many of our clients, the first time that we talk them through the benefits of a unit, they all worry about strata, and it is fair. We have heard the stories of those buildings that have, multiple lifts and tennis courts and pools. The strata can be through the roof. In fact, I once owned one a long time ago, and the strata was $16,000 a year, so it was incredibly high. But strata can actually be a benefit too, and I'll talk you through it. So what we look for, we don't buy those properties that have lots of common facilities, lifts, pools, gyms, any of that. We look for, like I said, brick buildings with 4 to 16 units, very low strata. Now, what that actually looks like, the typical strata that we look for is between 1,000 to 3,000 a year. Okay, now the reason that we do that is because if you're to buy a freestanding house, you still have to have building insurance, which is included in strata. So typically a house insurance, depending on where you're buying, is between 1 and 3,000. So as a result, if the strata is between 1 and 3,000, it's basically the same as having a freestanding house. The only difference is, and this is a really important thing to note, if you own a house and something goes wrong with the roof and it's $20,000, well, that $20,000 is on you. But if you own a unit and that something goes wrong with the roof, yes, the roof might be $100,000 to fix, but if there's 10 of you, it's $10,000 to fix the new roof. So your major maintenance items are also split between the unit holders. Another thing is too, part of your strata is building up the sinking fund. So you may not even need to put an extra 10,000 in, that might already be accounted for. So strata, it can be bad, but it also can be really good, and it can lower your holding costs, in fact, rather than increasing them. Now, this is the most crucial thing when buying a unit, and I say this about any property type, and that is market timing. Units, houses, whatever it is, if you buy them at the wrong time, they're going to look like a terrible investment. And what I've seen, a lot of people that have bought units at peak markets, they're the ones that complain 5, 6, 7, 10 years later when it hasn't grown. So what we need to understand, when you're buying a unit, you need to be buying in a market that has been very suppressed for a very long time, so that you're buying under intrinsic value and And then when the market starts to turn, you're going to get that strong uplift. It'd be like the person that paid $1.80 for Afterpay shares saying they're no good and it wasn't a good stock to buy versus the person that paid 8 cents for them 3 months earlier, right? So you need to be the person that is buying the units at the right time to extract the maximum value, because the truth is, if you do buy them at the wrong time, if you do buy them at the peak of Melbourne 2010s and buy in Docklands, or if you do buy them in Brisbane, Adelaide or Perth right now, yes, you may underperform for a very long time, but that's the same as houses as well. An excellent example of this is, I'm talking about Melbourne today, but an excellent example of this is Darwin. Now, Darwin units had not done anything for a good 10, 12 years, but if you look at the market now, they are absolutely flying. So if you'd picked them up, you could have bought them today, or you could have bought them last year for the same price that they paid for them in 2012, and you're going to have an exceptional years of growth ahead of you now. So whoever buys them now is going to think that Darwin units are amazing. Whoever's held them for 12 years is obviously going to think they're no good. So down in Melbourne, we're buying them at prices that some previous vendors paid the same price, even sometimes a little bit more in 2010, 2012. It's incredible to think. We bought one the other day for $385,000, and 13 years earlier, they paid $385,000. So you can imagine they have underperformed in a big way, but that property already, only bought it a few months ago, it's probably already worth somewhere in the 400. So it just shows you the right timing is key with all investments. Okay, so now you know what to look for and what not to look for in a unit. Let me talk about some actual suburbs that we're seeing incredibly strong data. What I'm going to do, I'm going to show you one suburb that has extremely strong data, but just know that all the other suburbs that I show you as well, they have very similar data as well. So we are seeing a lot of strength, and probably the biggest thing that I'm noticing is a lot of these suburbs, they're suburbs that you'll know, they're actually kind of inner city, good quality suburbs in Melbourne. So the main one I'm going to look at, this has the strongest data. This is Essendon. So Essendon, you might know them. They have a pretty good AFL team. They're just north of the city. So the current median price in a unit in Essendon right now is $448,000. So still very affordable. Now, the 5-year growth, and this is what I'm referring to, has been minus 1.6%. So if we go back to 2021, the prices were a little bit dearer than they are today, which is actually like what we like to see. The 1-year growth has been 1.83%. So you can see there is a little bit of movement starting to happen very, very early though. Now, days on market. So this is what we like to see as far as competition in the market. Things are starting to sell quickly. It's at 33 days. So it's not like they're taking 100, 150 days. They're selling in 33 days, which is relatively quick. Stock on market is tightening big time, 0.43%. So it really is becoming quite a tight market. The vacancy rate is sitting at 2.34%. Now, what I'm starting to see is that things are renting out relatively quickly and that rents are starting to increase as well. So I do expect that to come down in time. This is a thing when you look at units and houses, right? Affordability metrics is a massive one for us. We like to buy properties where it takes 40 years or less to pay out a 30-year mortgage. That's the stat that we use. So a good affordability is, say, under 35. The affordability of Essendon units right now, so what that is local incomes relative to median prices, is 14 years. So that is incredible. It doesn't get much more affordable than that. The ISRAD too. So this is the socioeconomics of these suburbs. So a lot of the house markets, we're used to buying in, 1 to 5 out of 10 socioeconomics, which is completely fine. We're buying more blue collar suburbs, which is great that they perform just as well. The ISRAD in Essendon is 10 out of 10. So you're actually buying in basically a blue chip, high socioeconomic area with very strong affordability. So the growth score on this property right now, capital growth, and just to put it in context, anything over, say, 50 to 60 out of 100 is solid. That's good. Some bad markets, I've just done a video on Melbourne versus Brisbane. You'll see some Brisbane markets are showing 8 out of 10, just to put it in context. So Essendon units are showing a capital growth score of 85 out of 100. So we're looking at a very affordable median price. We're looking at a tightening market, less supply, more increasing demand, and we're looking at an 85 out of 100 score. So like I said, I'll give you a few other gold mine suburbs. So we've got Essendon 1, we've got Glen Iris 2, Footscray 3, and then we've got Malvern as another one. So they're kind of all inner city suburbs around Melbourne with very strong data. Now, I'm going to show you an example of a property that we bought and just show you how effective that this can be if you buy at the right time and buy the right property. So I'm actually from Melbourne originally. I live in Sydney now, but I couldn't believe it when I saw the suburb, because to me, growing up, Malvern has always been one of the best suburbs in Melbourne. So when I saw that we could buy this for $315,000, I nearly fell off my chair. So I'll show you this. This is a property now. just to put a bit of theory into the practical work, right? So I've explained. So look at this unit. We've got red brick, probably a 70s build. We've got 16 or less apartments. We've got low strata. You know, this is ticking all the boxes. Now, this is a 2-bedroom unit, 2 bed, 1 bath, 1 car. Very basic, but also like well presented. You can have a look. It was actually really nicely presented. Kind of newish kitchen, split system, carpeted bedrooms, 2 bed, 1 bath, nice and airy, nice and light. So really what you want to see in a unit. Now, if you have a look, we bought this property for $315,000 in May 2025. If you have a look on realestate.com, it said that in the last 12 months, it has grown 25.2%. Now it's coming in an estimated value of $394,000. When we bought this property, we actually got a bank val for the client at $420,000. So what he did, he was a young client. We bought this property. We got the bank val, we pulled out his full deposit, and we went and bought another Melbourne unit. And we're actually going to do that 4 times. So he's going to build from 1 deposit. We are planning to build a base of over $1.2 million of Melbourne units, and I'm very excited to see how well he's going to perform over the next 5 years. I must say too, this was an off-market buy, and we buy 70 to 80% of our properties off-market. So I'm not saying that these gems are just there in plain sight. You do have to fight pretty hard to get them, but you can see when they work out well, it can really set you up at the start. So who are these investments for? Well, to me, I think they're really good for a number of investors, but probably the biggest one I think is for first timers. The reason I think that is the price point. So you can pick these up between $250,000 to $450,000. So they are still affordable. And if you're doing it on a 10% deposit, you can get in with quite a low amount of cash. They also have a high yield, so 6 to 8%. Something I noticed with first time investors is they're very nervous about cash flow of a property, which is completely understandable. So by buying a property at 6 to 8%, it's basically neutral, sometimes even positively geared from day one. So you can put in a low deposit and have it basically covering itself. So it's very light on your actual lifestyle. And the third reason I think so is the market timing. The market is just absolutely prime for growth. So if you can get into an affordable property with the high yield and have strong capital growth, what more could you ask for in an investment property? Now, who should avoid units? Well, it's not for everybody. Now, we have a strategy at Compound. We look at cheapies, which is what I'm talking about today, foundations, which are houses more between 500 to kind of 900,000. And then we have our legacy properties, which are commercial properties. So if you're wanting to just buy a property, say, you don't really want to scale the portfolio too much, or you want to just be conservative, you don't want to hold too many properties, then Melbourne units may not be the best buy for you. You may want to stick to a house and buy maybe, aim to buy a few of those over a couple of years, and that is completely fine, and we help people with that too, but these can be great for a lot of number of reasons. So my honest take on Melbourne units right now, I think they're an incredible opportunity. If you look around the country, they have severely underperformed. They represent excellent value. And I love buying something from 10 years ago's prices. If you think about all the wage growth we've had, all the inflation that we've had, not many things are the same price that they were 10 years ago. Now, it's not all units of that, but we are seeing that, a fair bit of that across the market. We're also talking about Australia's largest city. So I know it's had its problems, but overall, Melbourne has a very bright future. And whoever invests in there, whether it be a unit or different types of properties, I think will get excellent results over the next few years. So if you want help buying high growth, high cash flow properties all across the country, please get in touch with Compound Property Buyers Agency, our link in the description below. Happy investing.